Good morning, good day to you all. My name is Lelia. I'm from Accounting Program Study, Universitas Dianuswantoro. Today, I will present my article with the title, The Impact of Liquidity, Net Interest Margin, and Capital Structure on the Profitability of Banking Companies. The profitability of banks is a key indicator of their health and performance. It is also very important for investor confidence and financial system stability. In the period from 2022 to 2024, banks will face major challenges due to macroeconomic fluctuations. Indonesian banks' net profit in the fourth quarter of 2024 fell 5.5% quarter-on-quarter and 3.2% year-on-year due to tight liquidity and increase in the loan-to-deposit ratio. The decline reflects bank sector challenge in credit growth due to competition and tight liquidity. A research gap exists regarding the impact of liquidity on profitability. Studies by Basmar et al. Winders, Berlianke, and Widianto found that liquidity has an impact, while studies by Ben et al. And Samuser had no impact. The impact of net interest margin on profitability. Studies by Alam and Zui, Ben et al., Desmond, and Nadira found that net interest margin has an effect, while Khalifah et al. Had no effect. The impact of capital structure on profitability. Studies by Jusandra and Mahroji Fitriandi found that capital structure has an impact, while studies by Arido et al. Has no impact. This research aims to provide empirical evidence on the impact of liquidity, net interest margin, and capital structure on banking companies listed on the Indonesian Stock Exchange. The research methods used is quantitative, using secondary data from the annual financial reports of 24 selected banking companies during the 2022 to 2024 period, which were taken using purposive sampling techniques and produced a total of 70 data observations. The table shows the variable measurement tools. First, for the dependent variable, there is profitability measured using return on asset, calculated by dividing net income by total assets, then multiplied by 100%. Next, for the first independent variable, there is liquidity, measured using the loan-to-deposit ratio, calculated by dividing total loans provided by total third-party funds, then multiplied by 100%. The next independent variable is net interest margin, measured by dividing net interest income by average total earnings assets, then multiplied by 100%. And the last independent variable is capital structure, measured using the debt-to-equity ratio, calculated by dividing total liability by total equity, then multiplied by 100%. Based on the literature review and conceptual framework, we propose three hypotheses. 1. Liquidity affects the profitability of bank companies. 2. Net interest margin has an impact on the profitability of banking companies. And 3. Capital structure affects the profitability of banking companies. Key findings: the regression model is suitable because the ANOVA significance value is 0.00, less than 0.05, indicating statistical significance. The adjusted R-square of 0.253 means liquidity, net interest margin, and capital structure explain 25.3% of profitability variations, with 74.7% due to other factors. From the hypothesis test, only the net interest margin variable has a significant impact on profitability, with a significance value of 0.00, less than 0.05, and the liquidity with a significance value 0.214 and capital structure a significance value 0.667 have significance value greater than 0.05, indicating they do not have a significant impact on profitability. Net interest margin has a positive and significant impact on bank profits. The positive impact of net interest margin supports signal theory, suggesting that management that is able to optimize net interest income sends a strong and reassuring signal to the market regarding the bank's operational efficiency and sound financial conditions. Liquidity and capital structure do not have a significant effect on profitability. Excess liquidity and varied capital structure often send ambiguous signals. High liquidity may indicate inefficiency, and diverse capital structure compositions does not always reflect profit-generating ability. The implication findings: Significance theory: net interest margin is important as a key indicator of a bank's financial health and efficiency. This encourages the development of financial signaling theories that emphasize the quality of productive asset management. Significance: policy. Banks and regulators should prioritize effective net interest margin management while balancing liquidity and capital structure. This approach is important to prevent financial risk and ensure banking system stability. And last, practical significance. Bank management needs to increase net interest margin and manage liquidity and capital carefully to ensure stability and profitability. Effective management implementation will strengthen the bank's financial position in the long term. That concludes my presentation. Thank you for your attention.